What exactly is inflation, and why does it matter to your wallet? Let's break it down in less than 3 minutes. Inflation is simply the gradual loss of your money's purchasing power over time. Imagine heading to the supermarket with $100 today and filling your cart. If inflation rises, that same $100 will buy you less next year. The money hasn't changed, but what you can get for it has. So, what causes inflation? It's not just about one or two items getting more expensive. Inflation is a general and ongoing rise in the prices of a whole basket of goods and services. The main driver is the balance between supply and demand. When more people want to buy things than there are things available, prices go up. There are 3 main reasons inflation can spike. First, demand pull inflation happens when households and businesses want to buy more than the economy can produce. This extra demand pushes prices higher. Second, cost push inflation comes from unexpected events, like wars or pandemics, that make it more expensive to produce goods. When energy or raw materials cost more, those costs get passed on to you. Third, monetary expansion occurs when central banks pump too much money into the economy, making each dollar worth a little less. But what about when inflation falls? That's called disinflation. It usually happens when interest rates go up, making borrowing more expensive and slowing down spending. It can also result from supply chains getting back to normal, energy prices dropping, or even an economic recession when people cut back on purchases. Who keeps an eye on inflation? That job falls to central banks, but they rely on official data. In Europe, national agencies report price changes to Eurostat, which creates the Harmonized Index of Consumer Prices. In the US, the Bureau of Labor Statistics calculates the Consumer Price Index, but the Federal Reserve prefers a different measure called Personal Consumption Expenditures, which better reflects changes in what people actually buy. Both the European Central Bank and the US Federal Reserve aim for inflation around 2% per year. This level is considered healthy. It protects your savings from losing value too quickly, but also avoids the risk of falling prices, which can stall the economy. The ECB acts quickly if inflation moves away from 2%, while the Fed allows for some flexibility, averaging out periods of higher and lower inflation. Who benefits from inflation? If you have fixed-rate debt, inflation can actually help you, since the real value of what you owe goes down. Owners of real estate or commodities also tend to benefit. On the other hand, stable or low inflation is better for savers, pensioners, and industries that need predictable costs. So, what can you do? When inflation is high, consider making big purchases sooner. Look for ways to earn interest on your savings and adjust your shopping habits. When inflation is low and stable, it's a good time to save, invest, and plan for the long term. So, was it worth watching this video? Want to learn more? Check out the MyFriendlyBudget blog.